Welcome to The Explainer. Today, we're diving deep into a real-world business case, swapping the abstract for the actual. We're heading to a resort in Tanjung Lesung to get our hands dirty with one of the most critical concepts in all of microeconomics, something every single manager has to master: cost structure.
All right, we're going to tackle this just like a business school case study. First up, we'll pinpoint the core problem plaguing our resort manager. Then we'll use some solid economic theory to figure out what's really going on. After that, we'll contrast our hotel with another local business to really sharpen our understanding. And finally, we'll lay out a powerful strategic fix. Ready? Let's jump in.
Okay, so let's get right to it. We're starting with a puzzle, a real paradox that gives hospitality managers nightmares, especially when the tourists aren't around. It's an issue that's at the very heart of any business that requires a huge upfront investment.
I want you to picture it: a beautiful, sprawling resort in Tanjung Lesung. It's the off-season, and it is completely empty. Not a single guest. Now, your first thought might be, hey, no guests, no costs, right? Wrong. So wrong. Even with absolutely zero revenue coming in the door, that business is burning through cash like you wouldn't believe. And this isn't just about hotels. Think about an airline flying a plane that's half empty, or a giant factory where the machines are sitting idle. Figuring out why this happens is the absolute first step to managing it.
So, to solve that puzzle, we have to roll up our sleeves and do a little financial forensics. We need to dissect the hotel's financial DNA into two totally different but totally critical parts. And let me be clear, for any manager out there, this isn't just some boring accounting task. This is everything. Understanding this split is the key to grasping your company's real risk profile and its true potential for profit.
So first up are the fixed costs. Just like the slide says, these are the bills that show up every single month like clockwork, no matter what. They don't care if you're fully booked or completely empty. Think of them as the financial rent you pay just for existing. They are the bedrock of your operation, but they can also be the heavy anchor that drags you down.
And for a resort, we're talking about a massive commitment. The source material says the total investment is in the billions. Now that's more than just an expense. A lot of that is what we call a sunk cost. Once you've spent that money on land and buildings, you can't get it back. It's gone. And that creates this enormous ongoing burden. You've got depreciation, maintenance, property taxes, and of course, the giant interest payments on the loans you took out to build the place. This is the mountain of cost you have to climb every single month before you've even made a single dollar.
Now, on the other side of the coin, you have your variable costs. These are totally different. They're directly tied to having a paying customer in the building. No customers? These costs are basically zero. The more guests you have, the more these costs go up. It's a beautifully simple, direct relationship with how busy you are.
And here's where it gets really interesting for a hotel. Look at how low these costs are. Let's put on our manager hat for a second. The cost to clean one more room, provide some shampoo, wash the sheets, maybe offer a simple breakfast, what's that, maybe 20 bucks? So if you can sell that room for, say, $100, your variable cost is $20. That extra $80, that's your contribution margin. Now, it's not profit yet. It's the contribution that room makes toward paying down that giant mountain of fixed costs we just talked about. And this explains the whole game of last-minute discounts. Any price you get that's over $20 is a win. Selling that room for 30 bucks is way better than leaving it empty.
Okay, to really hammer this point home, we need to see how it plays out in the real world. To really get the strategic side of this, we're going to compare our hotel, with its massive fixed costs, to another local business, one with a completely different financial makeup. And this table just lays it all out, doesn't it? The hotel has what economists call high operating leverage. Because its fixed costs are so huge, once it gets past its break-even point, profits just explode. But if it stays below that break-even point, the losses are catastrophic. The seafood shack, on the other hand, has low operating leverage. Its fixed costs are tiny, a simple rental, maybe. Its biggest costs are all variable, the fresh fish it has to buy every single day. This makes the shack's business model way less risky, but it also means it can't scale up its profits as dramatically in a boom. These two completely opposite structures demand completely different strategies from their managers.
And that quote really gets to the heart of it. If nobody shows up for dinner, the restaurant manager just doesn't buy fish for the next day. Their costs drop like a rock. They have incredible tactical flexibility. But the hotel manager? They can't just call the bank and say, hey, not going to pay the mortgage this month, nobody's here. This is why hotels have to be so aggressive with their pricing in the off-season. They are desperate for any cash flow to help feed that relentless beast of fixed costs.
So if you're that hotel manager, what do? How do you escape this trap of massive fixed costs? Well, this brings us to a really powerful strategic move that smart operators are making to get some flexibility back and lower their risk. A lot of businesses in Tanjung Lesung are using outsourcing, and not just to shave a few bucks off their expenses. They're using it to perform a kind of financial magic trick. They're turning their fixed costs into variable ones. This is a huge shift in thinking about how to run a business. You move away from owning all your assets to simply accessing services when you need them. And that makes your whole operation so much more agile and resilient.
Let's really break down this laundry example from the source material. In the old model, you'd have to buy huge industrial washing machines. That's a massive upfront capital investment, let's say $100,000, that then sits on your books as a fixed cost. In the new model, you just pay a local laundry service, maybe $2 for every kilogram of sheets and towels they wash for you. See what happened? You just converted a fixed cost into a purely variable one. As a manager, you've just offloaded a huge chunk of risk. With the old model, that $100,000 machine is costing you money every single day, whether it's running or not. In the new model, if you have 0 guests, guess what your laundry bill is? 0. You've traded a large, certain cost for a smaller, manageable one that scales perfectly with your revenue.
Okay, let's bring it all home. We've diagnosed the problem, we've applied the theory, and we've looked at a strategic solution. So what are the big ideas, the core principles you need to take away from this little microeconomics masterclass?
Look, the big takeaway is this. Understanding your cost DNA, that unique mix of fixed and variable costs you have, isn't just for the accountants. It is the absolute foundation of your entire business strategy. It determines your pricing, your break-even point, your exposure to risk, and your ability to survive the market's ups and downs. A great manager doesn't just manage the cost structure they're given, they actively work to build the right one for their goal.
And that leaves us with one final question for you to think about. Whether you're a manager now or will be in the future, take a hard look at your own business, your own department. Find those fixed costs that create that financial stiffness, that risk, and then ask yourself the big strategic question. How could I use outsourcing or technology or just a different business model to turn some of those fixed costs into variable ones? How can I build a stronger, more agile, more resilient operation?